Thanks for joining us today. I'm Cindy Nace. I'm Executive Director for CFA Society Cleveland, and I will get things kicked off. We're winding down what we call our season. We don't hold anything over the summer, so we've got kind of our big networking party on the 25th of May at Collision Bend. Anyone is welcome. That's May 25th, 5:30 to 7:30 or so. So please join us if you can. And then the last event we have for the season will be June 1st, and it's a women-only event. It's a women's networking happy hour. It's going to be out in Pinecrest. And we have a speaker coming who's going to be talking on, I think it's authentic leadership style or something. I can't quite remember what it is. We went over so many different topics. But it is on the website. Please join us for that also. As usual, you do not have to be a charter holder to join the local society or come to our events. Everybody is welcome. I'm going to turn it over to John. He is our programming chair, and he's done a great job with all the programming this year, and I'll let you take over.
Well, thank you, Cindy. We're incredibly excited to have Cleveland Cliffs here today. It's also Gonsalves, the CFO, Paul Finan, Senior VP of Finance, as well as a special thank you to James Kerr, who helped get this all set up. Just very briefly before we get to our fireside chat here, a special thank you to Cindy. This has been an incredibly turbulent year at the Society. We've gone from in-person to out-of-person to streaming, back to in-person to west side to east side and everything in between. So just a few quick highlights. We held over 35 events this year. Many chapters around the country did not hold any events. We've explored different locations on the east side of Cleveland as well as our historical home here at the City Club. We've done small group forums, bringing people together around coding and ESG and as well as candidate forums. So we've tried a little bit of everything to try to bring our membership together. So we want to thank you, everyone who's been here. A special thank you to Art. Historically, we've always had these kind of discussions with corporate leaders from throughout Northeast Ohio. In recent years, it hasn't been as prominent a topic on the agenda. And Art's idea to bring in some executives here with a company that's transformed in an exciting way, that's continuing to progress in a way that gets us all excited as Clevelanders. So with that, thank you both for joining us today, and Paul, I'll turn it over to you.
Thanks, and yes, likewise, thank you everybody for joining. I'm sure everyone in here is Cliffs, so I think just to baseline everybody, we're going to kick off a conversation. I'll ask some questions to Celso. He'll explain what we've done, where we've come from, our recent transformation, and then at any point, please feel free to interject, ask questions, whatever you would like to ask. But I think just to start it off, Celso, if you want to walk the audience through just who we are, where we've come from, and really highlight the recent transformation we've done over the last couple of years.
Yeah, sure, and thanks again for having us. It's a pleasure to be here. I know not everyone's even working from downtown, or people came from faraway places, so I appreciate you guys being here and the interest in Cleveland Cliffs. Cleveland Cliffs has been around for 175 years. Actually, yesterday we were at the New York Stock Exchange celebrating our 175th anniversary. We've been listed in the New York Stock Exchange since 1960. And we've been right here in Cleveland the whole time. So I won't go through all 175 years of history because we don't have that much time, but I'll just highlight some of the accomplishments that we've done. I think our biggest transformation has happened in the last 2 years, where we've transformed ourselves from an iron ore company to a steel company. But rewinding back a little bit further to maybe 2017-ish when I joined the company had already gone through a transformation. It went from being a kind of a diversified mining company of various minerals into focusing on what the core business was, which is supplying iron ore pellets to the steel industry. And if you're familiar with the steel industry, there's really 5 main players in the United States, at least at the time. Nucor, Steel Dynamics, AK Steel, and US Steel were really the top steel companies in the US. And we were supplying, we were actually not able to supply Nucor and Steel Dynamics because of the way that I won't get into the metallurgy, but they run what's called electric arc furnaces, and the pellets that we produced didn't work in their furnaces. So we invested $1 billion here in Ohio, in Toledo, to build what's called an HBI facility, essentially transforming our iron ore pellets into a material called HBI that we could sell to Nucor and Steel Dynamics. So that was really the thesis behind that investment. And what we quickly realized is that Nucor and Steel Dynamics were not as interested in the product as maybe they should have been. So when we realized that they weren't going to buy the HBI from us, we decided that we were going to buy AK Steel and ArcelorMittal USA in order to compete with them. So that's exactly what we did, and I'm sure we'll get into the details of how that went down. But that's really what's happened in the last 5 years.
So can you give a magnitude of what was revenue before this transformation, what was revenue after, what was EBITDA, what were some of the important profitability metrics?
Yeah, I mean, we went from $2 billion of revenues to 20+ billion. So a little bit of growth there, obviously driven by M&A, but it's been a big transformation.
So is there any further M&A you're thinking about or we're thinking about here over the next couple of years, or are we happy with our footprint and plan to just optimize what we have?
Yeah, I mean, M&A is a tricky thing because you can have your shopping list and then the world changes, right? So it's really hard to say we're going to go one way or the other. I mean, we're always evaluating M&A opportunities, whether it be downstream or competitors, or raw materials. We're always looking, but we're not committed. This afternoon I have a meeting with Wells Fargo actually to talk about nuclear power opportunities. So those are just things that you always have to think outside the box. We recently made an acquisition in the scrap industry to further strengthen our raw material base. So we're always open. We have great advisors. We always have our shopping list. And if things become available, we're always looking. But we're happy with the footprint that we have right now, and it's all about exercising the commercial leverage that we have. I think a lot of our customers still haven't even realized what we've become, right? Particularly in the automotive sector. I was telling John, we're the largest steel supplier to the automotive industry, but a lot of our clients haven't even realized the consolidation that we've done. They think that they can play AK Steel against ArcelorMittal USA, and if they don't get the pricing they want, they can just call. They think they're talking to AK Steel only, and then they're like, oh, we'll just call AM USA then, and then the phone rings in the other pocket, and we're still talking to the same person, right? So we're still going through that educational process with our customers, and it takes a while, right? It takes a while for people to realize what we've done, but we're really happy with the portfolio that we have.
So you mentioned the consolidation, and the steel industry has a long history prior to Cliffs being directly involved of very poor allocation of capital and a fragmentation that really doesn't lead itself to outsized shareholder returns. So do you think what we've done here over the past couple of years in terms of not just growing our company but consolidating our industry, do you think that leads to a better future for steel and market performance of steel stocks relative to what they've done historically?
Yeah, I mean, I think so. I think, together we're stronger than we are separate. And, we're the only company that's vertically integrated. I think that's very important because I mentioned Steel Dynamics and Nucor, and as you can tell, we don't like them. They rely on importing raw material from Russia, and that's just part of their business model. When we built the plant in Toledo, we were giving them an opportunity to have a locally sourced raw material that they could buy from us. We thought we were doing them a favor by building that plant, and we thought that they would seize the opportunity, but they didn't jump on it, and they still, to this day, rely on importing what's called pig iron from that region of Russia and the Ukraine. If you go back to our presentations from 2017, we basically were pitching to them, hey, we're giving you an opportunity to unleash yourselves from this unreliable, we called it an unreliable and unpredictable part of the world, but they didn't jump on it. So, we became vertically integrated, and we use that product internally, and we're very happy with it. It's an environmentally friendly product as well. So now we're competitors, and we're going to keep competing with them.
So if they would have taken your product, you probably wouldn't have consolidated?
Definitely not, yeah. They, if we had been able to sell HBI to Nucor and Steel Dynamics, we probably wouldn't have become a steel company. Because that's what we were. We were a supplier to the steel industry. But when they didn't buy that product from us, we bought the companies that did value it in AK Steel and ArcelorMittal USA. And then we figured we'll compete with them on the other end. And that's what we've been doing.
So, last year you generated a record amount of free cash flow, over $2 billion. Used it towards acquisition of a scrap company as well as a major share repurchase, $1.3 billion share repurchase, lowered the share count by 10%. This year you're set to generate another record free cash flow in company history. Well, what are the intended uses of that cash as you think about growth or capital structure or return to shareholders?
Yeah, I mean, we've, as you guys know, when you make acquisitions, usually you have to take on a lot of debt, and that's what we did. So now we're in the process of harvesting that cash and paying down debt. That's the number one capital allocation priority. We really want to get our debt level down. From a leverage metric standpoint, we're very comfortable with our leverage. We have total leverage less than 1 times, which is very comfortable. But we still want to get the debt quantum down. We want to get the debt number down. And with all the cash that we're generating this year, we're allocating all of our cash flow toward debt repayment. We do have a share repurchase authorization in place, but to be honest, I don't really like buybacks, share buybacks, or dividends. To be honest, I'd rather keep investing in the business and paying down debt. But if we're only in May, and we've seen our share price go to 35 and 15, right? So if our stock price becomes really cheap, we'll buy it back, just because we can't pass up on a good bargain. But I don't really like either one of them.
Now, you mentioned the stock price volatility. Biggest event this year geopolitically being the Russian invasion of Ukraine. How does that impact your business, and how does that set you up competitively versus the likes of Nucor Steel Dynamics?
Yeah, I mean, like I said, we're the only ones that have, we're vertically integrated. We own our mines. We mine iron ore out of the ground to make pellets and then make steel, whereas our competitors rely on this unreliable product coming out of Russia. So that's really our competitive advantage, and I think investors are starting to realize that, and it's been reflected in our share price. But no one else, every other steel company in the U.S. Has to import product from that region of the world, and if it's not that region of the world, it's other places that are just as unreliable. So that is really our competitive advantage. We have 26,000 employees here in the United States. We're U.S. focused, and that's really what differentiates us from our competitors.
And your largest end market, automotive, been a rough past couple of years for them. 2020, we're hit by COVID, a lot of plant shutdowns, and then coming out of that, 2021, it was a semiconductor shortage. So really, it's been an industry that has been much slower than typical for the past couple of years, and still hasn't fully recovered. Now, what would that mean for Cliffs if automotive were to get back to some semblance of normal here in the next 6 months to 12 months?
Yeah, I mean, it'd be huge. It is our largest end market, and we've done just fine despite the fact that end market has been relatively weak. So just imagine when automotive does take off and they're pulling a lot more tonnage from us. But we think that they're, from what we're hearing, they're working through their chip shortage situation. It's really a shortage of everything. I think the chip is just the excuse, but there's a shortage of everything for the automotive industry right now. And but I think what they're realizing is that they need to respect their supply chains more. When they shut down all at once in March of 2020, they ruined their supply chain entirely. They basically called us one day, March 15th of 2020, and said, hey, next week we're going to be shut down, don't send us any steel, and we're going to start making ventilators, and we're going to go on TV and brag to the world that we're saving everyone with ventilators. And they just completely shut down, and we had just acquired AK Steel, which was the largest steel supplier to the U.S. auto industry, and we were like, all right, I guess our revenues are going to zero. And they had no regard to what they were doing to us and other suppliers. And they expected that when they came back, that we would be right there, ready to go, just-in-time delivery. And what we did is we started to move tons to other industries that were doing better. We started selling a lot more to appliances, a lot more to things that were working at the time. So it's been an educational period for the auto industry. They're realizing that they depend a lot more on their suppliers than they thought previously. You can't, the relationship between the auto company and the supplier can't be a slave and master relationship. It has to be a relationship of equals, and you have to respect all of your suppliers, or else you end up in a situation where when you really need them, they're not there for you.
So as far as Cliff's business, I think that was pretty much a summary that, based on the questions we get from investors, that was kind of a summary of them. We want to open it up to you guys. We'll ask a couple more high-level, more personal questions for you, Celso. So you became CFO of Cliff's on, I believe it was September 1st.
Yeah.
What have you learned as being a CFO relative to prior experience, and what are your plans here for the future?
Yeah, I mean it's my background is in investment banking. I came in, I worked in banking for several years in New York, and then my father asked me to come join Cliff's when it was really a bad time for the company. He had a couple of treasurers resign on him, and he said, "Hey, I need the one job qualification I have is I need someone that won't quit on me." So that's when he called me and said, "Would you be willing to come and help?" And I said, "All right, well, I never thought I would work in the steel and in the iron ore industry, but here we go, let's do it." And from a personal relationship, we're an immigrant family. We moved to the U.S. 20 plus years ago, and we've always helped each other out. And when he came to Cliff's, when he did the hostile takeover of Cliff's, he came alone, right? So it was a challenging period for him, and I was honored when he invited me to come. And I came as assistant treasurer at the time, and we've been able to do all these things. We do things very quickly. And that's how I've been able to kind of rise up quickly through the company. But it's all about the team. Being CFO is not much different than what I was already doing, because I was already involved in a lot of the strategic things that we're doing. And as I move up, everybody moves up with me. I have a great finance team, and Paul and James and several others. So we're nimble. We're not very bureaucratic. My father walks around the office every day. We're 5 days back in the office now. Any ideas he has, he comes to me, he comes to Paul. That's how we do things. The board of directors is very supportive. It's, we don't do things by complicating them. We do things, we do the things because they're simple and they make sense. And that's really how we take care of everything.
And yeah, the last one, you touched on this a little bit, but you happen to share a last name with our CEO. I don't think that's not a coincidence.
Yeah.
And just if you could explain what that dynamic is like, and maybe shed some light on, especially such a unique CEO, what it's like to be not just his son but also his CFO.
Yeah, I mean it's pretty natural. I mean, he's a unique individual. I don't know if you guys are familiar with him, but yeah, he does things his way, and it's hard because a lot of times we disagree on things. We actually disagree on a lot. I think Paul and I agree on more things than we agree with him, but his instincts tend to be right, but we're there to play our role. And but you got to work for someone that inspires you, and I think that's really what he does, right? Not only to me, but to everyone at the company. So working for him becomes fun. It doesn't feel like you're working when you're having fun, and when you're really inspired by what you're doing, right? And it goes all the way to the ground level of the steel plant. It's really fun to go with him to a steel plant and see how he talks to the people the people that are full of grease, the people that are working, day in and day out, the way that he interacts with the lowest level of our company. He treats them the same way that he treats me. So that's a really fun thing to see, and his strategic vision is just differentiated, and you got to work for someone that you admire to that level. And I think it's not just me, I think everyone at the company does. So.
It's good. Well, I think that was enough to start the conversation here. We did want to open it up to everybody else for questions, so please don't be shy.
Tariff policy has had a big impact on the steel industry in the past. We had, if I'm not mistaken, something like 20% of supply had come from Russia, some amount from Ukraine. Of course, China was also a supplier. You think these things have changed dramatically and would be reflected in the valuation of the stock? What are investors missing about the outlook for steel imports? And you think that steel companies would be almost like the aluminum companies. The aluminum stocks have gone through the roof. They've come back, and you think Cliffs should be one of the major beneficiaries with its own supply, raw material supply.
Yeah. Yeah, I mean, I think the problem with the steel industry is that everyone thinks they're an expert, and everyone thinks that next year is going to be terrible. So that's the challenge that we're faced with every day. So there's no one in the world that thinks next year is going to be a great year for the steel industry. Everyone always thinks that tomorrow the world's going to collapse and the steel industry is cyclical, and it's going to be, everything's going to be terrible. So what we're doing is, we've only been a steel industry really for 2 years, and we've had 2 great years so far. So we're trying to change that mentality, but regardless of imports are just an excuse, there's a list of 100 excuses, but that's really the main challenge that we face. People come up with clever names like Steelmageddon or Sheet Tsunami or whatever it may be, but yeah, next year is always going to be bad. And I think pessimists tend to sound smart, but optimists make money, so that's what we're doing.
Well said.
I had never heard the backstory of the hospital takeover.
Mm-hmm.
Would you mind sharing that with us?
Yeah, sure. Well, Paul actually is probably more familiar with that than I am. I was seeing it from the outside, obviously, but Paul, I'll let you share how it was from the inside.
Of course. So for some deep background, the prior board of directors of Cleveland Cliffs leading up to 2014 was a complete disaster. Made terrible acquisitions, funded them all with debt. It was all part of an expansion to try to replicate the big global miners, the Rio Tintos, Anglo-Americans, the BHP Billitons of the world. And the assets they acquired to mimic this strategy were tier 4 assets, horrible assets, and almost a track record of almost zero. Zero, I think it was 9 acquisitions, maybe 1 worked out, and that was small scale. So batting average was, when you look at dollars, was probably like 0.020, like terrible. And they were so committed to those assets and that they would turn them around that there was no flexibility on, hey, maybe we should divest, maybe we need to think about the balance sheet a little bit more. So what it took was Lorenzo leading a hostile takeover and explaining to the shareholders with the fund he was associated with only owned 5% of the shares. He was able to convince a majority of the shareholders that this strategy was terrible, and they continue to dig their heels in. And what we need to do is get back to the core business, which is U.S. iron ore, which was always profitable through that cycle. And without the resiliency of that business, Cliffs would have probably not made it. So what Lorenzo did, he told this very compelling story, which let's stick with this business that actually works, and got shareholder support. So with 5% of the company, was able to get 6 board seats out of 11. Named himself CEO. Over time, and then within the first couple years, did a lot, divested out of a lot of the assets. We had bonds trading at cents in the dollar, so he used unique financing strategies to reduce those. Pay down $1 in debt, use $1, pay down 10. Those types of things when we had a lot of our creditors not believing in our story. So generated a lot of value in that way. And then the final thing was removing potential competition in the U.S. business, which was a big threat for that business as well, too. And ultimately signing the contract with ArcelorMittal, who we now own, that was about half of our volumes. There was a lot of skepticism on if we would be able to renew that because there was other options for them. And we ultimately renewed a better contract with them. And the rest is history. That put us on the right financial footing to ultimately make these acquisitions that transformed us. But yeah, it was quite an interesting time.
But funny backstory, so from my perspective, I wasn't at the company yet, and my father had retired. He sold his prior company, Metals USA, and he basically retired. And he was living in Florida, and one day he saw in the Wall Street Journal that Cliffs Natural Resources was looking for a CEO. you know, they were going through a transition, and so he kind of wanted to put his name, you know, in the ring to be considered, and he, you know, reached out to Hydrick and Struggles, who was kind of leading the search. And before he even got an interview, the recruiter said, "Nah, you know, your profile doesn't fit what we're looking for." So he was denied an interview, and he was really mad because he had never had a resume up until that point. And he actually put together a resume for the first time in his life, and didn't even get an interview. So then he decided to take over the company and fired all the board members and fired all the management team because, you know, maybe he would, if he had gotten the interview, maybe he wouldn't have even wanted to take the job. But that's a true story.
I don't have a feel for the company that I should have, nor for the people behind it, which I always think is the most important factor in evaluating a company.
Yeah.
Could you, I happen to think that most boards consist of too many golf playing partners rather than a love for their experience and expertise.
Yeah.
Could you speak to your father's experience and also to the board of directors individually, or a few of them, what they bring to the board other than their golf expertise?
Yeah, sure. Well, first of all, my father doesn't play golf. He's terrible at it. He's tried, and he, you know, when he retired, he actually tried to learn again, and he realized that he's probably better doing. It was easier for him to do a hostile takeover than to learn how to play golf. So put it that way.
I can understand that.
Yeah. So, but he comes from the operations. You know, he started his career working at the plant, and you know, that's one thing that sets him apart is the way he connects to every employee at the company from the operating level is just very unique. He's a metallurgist by background. He used to be a chemistry teacher, and he started working at a steel plant in Brazil. He grew up very poor. He went to great schools, and he got this job as an engineer at a steel company in Brazil, where, you know, in the town where I was born. But yeah, I remember when I was a kid, he would come home from work and he would be all dirty. He started working from the ground up, right? And he quickly rose within that company and ran the operations at CSN before being asked to come to the United States, you know, to be an executive. So I think that's what really sets him apart is the level of knowledge that he has of the operations. You know, he's not a guy that is, you know, you will never find him on the board of the Cleveland Orchestra or Playhouse Square or anything like that. He only loves to talk about work, and he loves talking to. He'd rather talk to the guy on the shop floor than Wall Street bankers. You know, that's just kind of his DNA, and I think the people that work for us really appreciate that. So it's really been great to see, you know, the people from the company that do the real work have the appreciation of his background, and he connects with them from that level. And it's been very important for our relationship with our unions. It's very unique because if you look at all the CEOs of the other companies, all of our competitors, they're, you know, former accountants and finance people, not to make fun of accountants or finance people, but you know, that's what sets him apart. And then at the board level, it's a bunch of people that he's known for a very long time, former board members of his prior companies. John Baldwin was at Metals USA with him. Douglas Taylor led the hostile takeover with him, and so forth and so on. So we make decisions quickly because we understand, the board understands his level of knowledge, and they're not there to question, they're there to support and to you know, maybe look at things from a different angle, but he's the one driving the bus and the board is there you know, to do their job. But it's a unique board dynamic. It's not a bureaucratic board like you see in a lot of big corporations.
Can you talk on your employee costs, how difficult it is to have people in the mines, and how do you see that advancing?
Sorry, what kind of costs you said?
You know, your employee costs, where,
Yeah.
you know, getting people to work in the mines.
Yeah, I mean, if you ever go up to that's an interesting question because, you know, our mines we have 5 mines in Michigan and Minnesota and the Upper Peninsula, and they're very remote areas. But people there have a pride in what they do. It's you know, you go up there and you meet with people. It's, you know, they're 5th, 6th generations of miners and people that really want to continue that lifestyle. So we've only improved our relationships with our people. You know, and then when we went into the steel industry, same thing. You know, the plant here in down, you know, the steel yard that was owned by ArcelorMittal USA, they felt like they were second-class citizens because they were, you know, part of a European company, and they weren't, you know, given the importance that they should have been given. But we look at our employees, we look at the unions as partners. It's not a contentious relationship. We tend to pay people really well. We're proud of that. You know, we don't look at our employees like costs. It's funny actually. When we're going through our budget for this year, you know, we gave people a salary adjustment that was above market, and it was coming from actually it was the finance team's idea to give more of a raise to our people. It didn't even come from usually you have HR proposing it and finance pushing back. Finance is the one who proposed it because we wanted to go above and beyond what HR wanted to do. So that's how we view our employees, and it's money well invested, and you get more than what you give. So that's how we think about it. Go ahead.
You talked about growth via M&A in past years and talking about American talking Wells Fargo about extra opportunities in nuclear power. How does your approach to growth fueled by M&A change with the shifting borrowing environment that we're seeing right now?
The shifting what?
Borrowing environment that we're seeing right now.
Yeah, it's a good question. I mean, yeah, interest rates are going up. It's just a factor of life given everything that's happened. But I mean, that's not really a lever that it's not a constraint. You know, if you want to do a deal, you need to borrow money, and it's a good deal. It's not because the cost of capital has gone up by a little bit that you won't do it. I think it's really more about the strategic vision and what you can accomplish, right? And then you just look back to the deals that we've done recently. You know, we've blown through all of our synergy expectations, and it's really about exercising the leverage that you created, right? So like I said, when we bought AK and then we bought AM USA, now we're using that combined leverage to flex our muscle to the OEMs and get the price increases that we feel like we deserve. And we're not price gouging them, you know, it's just a matter of realizing the value that you've created for your customer and charging appropriately for it, right? I think the steel industry in the past was quick to give up the farm when negotiating things, and you know, steel it's not cheap to create. You know, we have to pay people well. It's dangerous to make, so we want to make sure that we get paid for what we provide. And that's how we think about M&A too.
Yes, just quick background before I get into my question. We're all a part of 10 States Youth Managed Investment Fund. I've been in there a year like a gnat trying to get them to buy Cleveland Cliffs, and we finally did at the beginning of February.
Great.
Yeah, so just getting into my question. So I'm 22 years old. I'm 15 minutes from here, depending on how fast you drive.
Yeah.
In my experience here, I've pretty much only seen manufacturing lead. So one thing like I'm really appreciative of with your company is how you've integrated and have domestic focus. My question, going back to like trade and customs of the competitors who lean on Russia to supply their pig iron, do you think that the terminal end going into the future for your competition is mimicry, or do you think that they'll remain stubborn and keep trying to exploit like the foreign product?
Yeah, I mean, so that's a great question, and thanks for your interest. I mean, we love seeing young people that are interested in following us, so it's great. Yeah, I mean, we believe in manufacturing. If you don't believe in manufacturing in the United States, you can't be a Cliff shareholder. I mean, that is the backbone of everything that we do. If you believe that you need to make things here, you know, I don't know if you've been to a Cavaliers game recently, but we're a big sponsor of the Cavaliers now. One of the things that we put in the stadium is we want to be the foundation of American manufacturing, right? Because we want to bring manufacturing back. You know, the United States used to be the envy of the world when it comes to manufacturing, and at one point we sort of gave that up. And I think it's a mistake, and we need to bring that back. And hopefully, you know, our competitors will see that too, and there's a kind of a de-globalization theme, I think, happening right now, and we're very well positioned for it. I don't know if I answered your question, or is there anything you want to add, Paul? Yeah.
Like,
But that's how we think about it.
Are you seeing the onshoring happen? Are you getting more contracts with companies, more, how do you see that?
Yeah, I mean, I think people are at least starting to talk about it, right? I don't know, it's something that will take time, but do you have any examples,
Yeah,
Paul?
early days, I mean, the U.S. is the biggest importer of steel in the world, and Russia and Ukraine are two of the five biggest exporters. So that disruption actually led to a lot of our customers needing more steel from us, because they were supplementing steel demand from Cliffs with Russia-Ukraine imports that have since been cut off, or the cost is too high. It makes more economic sense to buy from us. So we've seen a big spike in that type of activity, and that's near term. But then if you think about the longer term implications, look at semiconductor shortages. I mean, and how much that has hurt a lot of industries. And now we're building semiconductor supply in Columbus, Ohio, for example. And these things should be building momentum, right? We realize with COVID how fragile the supply chain can be, and how extended we've made this supply chain with, in the name of lower costs and globalization. And I think COVID exposed a lot of the flaws with that model. Fortunately for us, we already have the right structure for a very tight supply chain, domestically focused supply chain.
How do you think of the strong dollar? You guys are buying, your competitors are buying, imports cheaper.
Yeah, look, we will take a weak dollar over a strong dollar any day. Is it a huge impact to our business? No, it's not a top 50 concern in terms of magnitude when we put together our forecasts and our sensitivities for the year. But we would prefer there to be a weak dollar as opposed to a strong dollar. For that exact reason.
Can you talk to how you manage revenues given the volatility in steel prices?
Yeah, so we are exposed to the volatility, obviously, but we're actually less exposed than our competitors. Another thing that's unique about us is that 50% of our revenues are locked with fixed contracts. And I don't think that's fully appreciated by the investment community. I think people are very quick to trade in and out of our stock based on what steel pricing is doing that day. And I don't think that's how it should be, because half of our revenue is contracted on an annual basis. And what we've done over the last year is increase the prices, particularly with the automotive companies, and lock in better, fixed contracts that are not impacted at all by the fluctuations in the market. And then we do have, the other 50% is obviously exposed to spot pricing. And we are very sensitive, admittedly, to what happens to spot pricing, HRC spot prices. But it's less than what you think, because we're sort of naturally hedged by that 50% fixed exposure that we have. So we like that dynamic of having half of our volume fixed and the other half floating.
Just following up on that question, what's your outlook then for that volatility going into 2022 into 2023 then?
Yeah, like I said, our outlook is different than I think what research analysts have. Like I said earlier, everyone thinks that steel prices are going to collapse next year, right? And what we're trying to explain is that there's a new normal. When you consolidate this much, we have pricing power. We're not going to let prices fall beyond a certain level, right? What you saw last year, steel prices went all the way to 2,000 almost, and then when they came down, as soon as they touched 1,000, it came back up, right? So I think our view is that you're going to see higher highs and higher lows going forward, and we're not going to normalize at the low levels that you've seen in the past.
I think there's a big story in steel on sustainability because it's recyclable.
Yep.
And should have a big advantage over plastics in some applications, many applications, some applications. I wonder whether that's something that you're thinking about in advancing and publicizing.
Yeah, it's true. I think steel is actually the most recycled material in the world. And you know, when you compare it to something like aluminum, for example, there's a big trend in the auto industry to try to make things out of aluminum that you can make with steel. And it's our job, and what we're doing is explaining to the auto industry that there's no benefit in going to aluminum. You know, aluminum is a little bit lighter, but it's actually, when you compare it from an emission standpoint, it's actually much more polluting. So we're working with all of the OEMs to bring back steel to cars that are now being made with aluminum. For example, Tesla. When Tesla first came out with the Model S, it was made entirely out of aluminum. But then when they went to the Model 3 and the Model Y, it's all steel. And part of it is the fact that it is more recyclable, it's easier to fix. You know, there's kind of a closed loop with steel scrap, that you can remake steel out of steel scrap. So it is a big trend, and it's something that we're trying to educate people, because it's easy to say, you know, there's a perception that steel is a dirty industry, and it's really not, especially in the United States. You know, steel manufacturing only accounts for 1% of emissions in the United States. You know, I think a lot of people think that it's much more than that. Paul, you do a lot of work with this, so I don't know if there's anything else.
And I think I would just piggyback on the 1% of steel emissions, that more than 50% comes from tailpipe emissions from cars and energy, right? So steel is actually going to be foundational to those industries decarbonizing, with auto vehicles moving more from internal combustion to electric vehicle, and then you have steel moving from fossil fuels over to renewables, which solar, wind, those are heavily steel intensive type operations. So steel was actually not the problem when it comes to CO2 emissions. It is the solution to the problem, and that greening of America is going to generate a lot of demand for steel here over the next several decades.
Yeah, so kind of going back into autos, so I'm familiar with the man that sells non-production equipment to GM. Correct me if I'm wrong, you guys are like their largest steel supplier, right?
For General Motors, yes.
Yeah. So like, you know, in Tranhead in St. Louis, right, the production there is virtually non-existent, which is kind of what happens whenever you put semiconductors in the car. But what I was going to ask is, in our analysis before we added to our company, one thing that I noticed is that your end market, like by revenues, there's starting to be a lot more parity, whether it's appliances, infrastructure, and then autos. What I wanted to ask is, like, going into the future, whenever autos are in a rebound, do you think that they're going to just immediately take back their position as your lead sales leader?
Yeah, I think, like I said, you know, during the pandemic, we had to sort of reallocate volume to other industries. You know, when we realized that the OEMs weren't pulling as much as we were hoping they would, you know, we moved a lot of tons to the spot market. But now we're in the process of refocusing into the auto industry. If they go back, you know, the last few years, there's only been, 13 million cars built per year, when in a time where demand was 20, you know? So there's still a lot of pent up demand, and as the OEMs work through these shortages and they start to produce more cars to replenish their inventories, you'll see automotive become even more of a fraction of our overall volumes.
Thank you.
What about like with the Russian current events and the renewed interest in energy independence? What about like shale exploration and demand around those industries? Are you seeing any unexpected demand in different industries in the need for steel aside from automotive?
Paul, I'll let you comment on that.
Yes, in the energy industry is a huge consumer of steel when they're drilling, and it was a nice support for steel prices up until 2014, and then that market has collapsed and really has not recovered. What we're finally seeing is some acceleration in that end markets, because yes, that industry can and will use a lot of steel if they pick up their drilling activity, and I think there's something patriotic to us having even more onshore energy supply, even if it's still from fossil fuels, and again, it's very steel intensive industry. So yeah, another kind of positive piece of outlook for us if that continues to emerge.
So two questions, if I may. Number one, you alluded several times to the dominant position you have in your sector of the industry, being automotive. How much does automotive count for your total revenues? And what are the other industry breakdowns of your customers?
Yeah, so it's about a third right now. We'd like automotive to be close to half. And then our biggest end market is really the distributor, the service centers that further process the steel, and then it goes into, appliances is a big one, some construction, but then it becomes, pretty diversified from there. We don't have a lot of exposure to energy. What else is there?
Machinery and equipment, military functions, shipbuilding, those types of things, yeah.
And secondly, it seems to me that what the street is questioning in the way of your low PE is your sustainability over the next few years.
Right.
To what extent are you differentiated from others in the industry? And to help you get through the environment that you mentioned at the outset being a negative outlook.
Yeah, I mean, it goes back to the question the gentleman asked. I think one thing people don't fully appreciate is how much of our volume is contractually tied to automotive, right? Even if steel prices were to collapse tomorrow, it doesn't change anything related to our contracts. So we are actually much more resilient than our competitors on a downward environment. We don't benefit as much when things go up, but we also don't get hurt as much when things go down. So that's a unique position that we have.
What are you doing to broadcast that differential characteristic to the investment community? Would you speak a minute to your investor relations and to what extent you've exposed yourself to it internationally?
Yeah, sure. I mean, we, obviously we have our earnings calls, quarterly, and we put a lot of work into the script. We go back to that script many, many times over and over with investors following the calls. We go to, investor conferences. Paul and I go, after earnings. Usually there's a couple-week period where we're on the road with investors for the following 2-3 weeks. We go to all the bank investor conferences. Paul leads our investor relations effort with James, and it's an open dialogue from our highest and largest holders to any retail investor has unique access to us. We put a lot of work into the materials that we put out publicly in terms of presentations. But it's an educational, it takes time, right? I mean, people still don't understand what we've done. And every opportunity that we get, we try to educate them. But that's really the main thing, is the 4 calls and then all the investor conferences that we go to. But we're available to investors to clarify anything. I don't know if there's anything you want to add.
Yeah, transparency is key, and it's why we're doing things like this, even today. Just any opportunity we have to tell our story, we think it's a good one, so we take advantage of all those opportunities. And really on that point, I think the first quarter really showed, because the first quarter we were actually in a declining steel price environment. And all of our competitors, their EBITDAs were down, their sales volumes were down, their prices were down. Our EBITDA was pretty much flat, our sales pricing was actually up, and our volumes were actually up. So it is interesting, in a downward price environment, which everyone thinks is right around the corner, we do stand out the most. Now we happen to be in a rising price environment, which we prefer, but then we get looped in more with the more commodity type producers in those types of environments.
Have you made any comment about the current quarter or the outlook above and beyond the generalization that you cited here, or is that not your plan?
Yeah, we have stated we do expect volumes to continue to pick up. Demand is increasing, particularly on the automotive side, so that is helping us. And pricing, we have increased contracts that we re-signed in April 1st, so our outlook is pretty good.
You mentioned something about acquiring a scrap company. How's that played out?
What was like the main driver behind that?
Yeah, that's a good question. So, you know, as I mentioned, Nucor and Steel Dynamics don't use pellets when making steel. They basically melt scrap. So scrap is their main raw material. What we did, and we use some scrap too, but what we did essentially is realizing that scrap is their main raw material, we went and acquired a scrap company that supplies our competitors. It supplies the whole market. But the whole thesis behind that was to make the scrap market tighter in order to make our competitors' costs higher so that they have to sell steel for a higher price, and then it would benefit us on the top line. That's essentially the strategy behind acquiring a scrap company. We're not interested, they're interested in low scrap prices because that's their main raw material. We're not interested in we want scrap prices to go up because it'll make steel prices go up, and it won't impact our cost structure as much as it'll impact our competitors. So it's really a way to squeeze their costs and in hopes that it'll keep steel prices higher.
Thanks.
Yep.
So I have a question about things that you said about how the world has changed since COVID and for supply chains within a country. Do you guys also believe that you guys will be able to compete as a price-wise as the cheap people better? Or is this like the way you said about how countries gonna have more supplies, like domestic supplies, because the benefit that it brings that you want like push it back or it won't cause any supply chain issues? Or is it because like, I guess what I want to say is that.
So can you compete without the tariff?
Yeah, yeah.
So I'm not sure if I fully understand it, but there's a big fan behind me, so it's hard to figure it out.
So I'm asking, can you compete without the tariff?
Can we compete without the tariffs? Yeah, I mean, we just want a level playing field, right? I mean, Paul, I'll let you talk about tariffs all the time, so go ahead.
Right, I mean, the US has historically had a higher cost structure for steelmaking in other countries, primarily because there's labor, there's subsidies that other countries have benefits on that we don't have, right? So what tariffs have done historically have just evened out that playing field, right? Really, most steel that's imported here on a regular basis does not have a tariff associated with 75% of steel. So there's a lot of media around steel tariffs and Section 232. There's actually, we've walked back most of those tariffs. They're really the only countries that have tariffs are countries like Russia, countries that don't exactly have friendly relations with the United States. So absolutely, and I think if you look at where the world wants to go in terms of decarbonizing the steel industry, the US already has the least carbon emissive steel industry in the world. And you think about a place like Europe, they have to spend a lot to get those mills down to the emissions intensity of US mills, and that's really dramatically raising their cost structure. So, and then if you think about countries like China, very similar, and they will have issues with using and procuring the scrap needed to have a lower carbon footprint. So really, the pendulum has swung back to the United States industry, and so we're absolutely competitive. We just don't think dumping is fair. We don't think subsidies are fair. Currency manipulation, those types of things, and cheap labor, wages. As long as we're level on those things, we will compete with anyone all day.
Yeah, and the other interesting thing too is that for a period of time there, China was overproducing steel and flooding the world market, right? They produced a lot more than they needed for their own consumption, for many reasons. They need to employ a lot of people, steel industry employs a lot of people in China. So they went from producing 100 million tons a year to producing 1 billion tons a year in a very short period of time. And they couldn't consume all of it, so they would flood the rest of the market with cheaply made steel. But now, if China has become really serious about curbing pollution, they're right-sizing their production as well. So they're not overproducing as much as they used to. So we're not seeing as much Chinese steel landing on our shores as we used to in the past.
Yeah, cybersecurity. How much time do you guys spend thinking about it, and how much resources do you devote towards that topic?
Yeah, I mean it's an important topic. Keith Kosey, who was our former CFO, he got promoted to president of what we call our services division. So he's in charge of all of our IT, all of our logistics, and you know, within IT, cybersecurity is a main topic. So it is a big focus, even at the board level. Obviously, the audit committee, it's something that they're focused on. You know, it's not really a threat every day. It's something that we're prepared for, but it's you know, we're as ready as we can be for anything like that.
Can you get some color around the royalty cost? I think is at North Shore relative to your other mines. Is it double or and maybe like production?
Yeah, it's our highest royalty structure that we have, and that's why we've decided to cut some of the production down. Paul, you probably know more about the history of the Wasabi Trust if you want to go into that.
Well, most royalties are production based, so it's a pretty set amount based on production. That royalty happens to be revenue based, and as our revenues have grown pretty significantly here over the past couple of years, particularly per ton of iron ore, that royalty has skyrocketed, right? So it has made that the cost structure of that by far our highest cost structure mine. So in the event, we do have excess iron ore capacity. So in the event we don't need all of our iron ore, it is a finite resource. We're not going to make it just to make it. So that is a lot. It has made the decision very easy on which mine to curtail in the event that we don't need all the ore we can produce.
What do you mean by revenue based?
Revenue per ton of ore. So if you make $90 per ton, you pay them, call it $5 a ton. If you make $250 a ton, you're paying them $25 a ton.
Right. So, but in your situation, being it's intercompany, you just use a market base.
So we do still have third-party arrangements for that particular grade of ore. And what we've done over the past year since we acquired Arcelor was we developed a way to make that ore at another mine. So we've mitigated that problem, and that was why we needed to keep that mine running last year. We've mitigated that issue with ore from Menorca, so now we no longer need that to fulfill any contractual arrangements. So beyond that, once that ore gets flushed through in the next year, and we don't have production, that royalty should no longer be an issue.
You mentioned that you're not the biggest fan of like repurchases or dividends. Do you do anything else to kind of give back to shareholders, or is it just, do you think it's justified because you're just taking that money and investing to better the company?
Yeah, I mean, if you look at all the value we've created by making the acquisitions that we've made, right? That's exponential value that we've created. Look at our share price performance over the last few years. That's much higher than just giving a 2% dividend yield to someone. That's just money that's leaving the company. You know, and then investors have to pay taxes on that. So, you know, that's how we think about it. In terms of buybacks, you know, you can't control what the stock price is going to do on a daily basis, but if things become really cheap, you have that lever to pull. But we're not, you know, we're not actively repurchasing shares. We don't have like a scientific formula that we use in terms of a percentage of cash generated that we apply towards buybacks or anything like that. We believe much more in reinvesting in ourselves and generating a return on investment based on what the share price does. And then the investor can decide whether or not he wants to sell the shares and liquidate themselves. But for now, you know, because we do have some debt on the books, we want to continue to pay that down and transition, you know, transform enterprise value into market value, into equity value. You know, at one point, if we run out of ideas, we'll probably institute a dividend, but you know, for now, we'd rather continue investing in the company and making our stock price run.
Yeah, so again, another part of my analysis, I was just thinking about any good reasons I could come up with to put you guys on fund. One thing I noticed is that you guys are probably there right now, if not extremely close, to being a consideration for inclusion in the S&P. Do you guys ever have that in the back of your heads?
For the S&P 500?
Yeah.
Yeah, so there's, it's a good question. So from a size standpoint, we qualify, you know, we basically qualify on basically every metric. Actually, the Fortune 500 list should be coming out soon. I don't know if it has yet, but we I think from a revenue standpoint, we'll be in the top 200 largest companies in the U.S. but the S&P 500 inclusion is it's a committee, you know, and we probably won't be included in the S&P 500 for a while. There's only one company in the S&P 500 in our industry, and that's Nucor. Even Steel Dynamics, who has been, you know, qualified for many years, is not included in it. So, you know, we probably won't be in the S&P 500 for a while. But, you know, we're fine with that. There are other indices that we're part of. Yeah, it'll be a while before we're in the S&P 500.
Well, I know these folks are busy. I just want to say thanks to Celso, Paul, James for coming on over here today. We're looking to do more of these next year. So on behalf of the CFA Society, thank you all so much for joining us.
Thank you. It's a
today.
pleasure.